Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Ken Hurley, kind of long-term care guru. Anthony, what was a takeaway or two that you had?
You know, what I'd like to preface before I talk about some takeaways that Ken dropped is that this podcast is a little different subject matter. I mean, we're typically talking about creating passive income or infinite banking, and this is really neither. However, we think it's very important, but also a lot of our listeners probably aren't thinking about long-term care. You know, a lot of them might be in our 30s and 40s, but if that's the case, what I know many of you are, maybe this specific episode doesn't relate to you, but I guarantee it may relate to your parents. And the problem is, if your parents aren't prepared, that's going to flow down to the children. So I think there's some good information in here, because your long-term care, of course, everybody thinks it's not going to happen to me, right? It's going to happen to everybody else. And hopefully you're right. But if you're not, this can destroy the plan that you have for retirement. If your expenses jump up $5,000 to $7,000 a month, you need to have a plan for it. So I think there's some great options that Ken had laid out to give you, so you can be aware of what some of those options are. And what he had talked about, what my takeaway is long-term care can be expensive, and you can have it for a long time. We don't know how long it's going to be, but some of the solutions he discussed allows for a lifetime rider. Because like I shared, my mom has been in assisted living, and now she's in memory care. And that had really thrown off the monthly cash flow that she was having. And her care is more than the monthly expenses we had budgeted for what she had needed. So, but fortunately, she had a traditional long-term care policy, and it's a great policy, but unfortunately, those policies are no longer available. So Ken had shared some options. Or some of your takeaways, Cam?
Takeaways that I had was long-term care industry has changed dramatically over the last 20, 30, 40 years. I've met with clients that have long-term care policies, and there's always frustration that is associated with those. They've kind of felt like there's decreasing benefits and premiums have increased over the years. And so it's like this love-hate relationship that they have. They're glad they have it, but they hate it because of those two reasons right there. Some of the strategies that or options that Ken is going to discuss today really addresses two big frustrations that people have with that right now. One is that the prices are now locked in and they're guaranteed. But also, too, what a lot of the insurance companies have done is they've actually created a hybrid product where it is now long-term care / life insurance. So there is a death benefit on there. So one of the main reasons that people have those is that, or one of the frustrations they have is they don't use it, they lose it. So this new hybrid product solves that situation. So if like Anthony said, is if you guys have parents that are aging, or you guys are concerned about this, there's some opportunities out there for you to start to look at for sure. And Ken talks about those today. So hope you guys enjoy this interview. Again, we interviewed Ken Hurley. He's a regional sales director with One America, a great mutual life insurance company that's out there. He's been in the industry, his bio says, for 36 years, and he spent 34 of those in that long-term care space. So he has a ton of knowledge. Great resource for us and for you guys. He's educated and trained thousands of financial professionals from coast to coast, and we enjoyed interviewing him here today.
You know, we had also interviewed him a while back when we did a webinar. We had that recorded, and that is part of the many videos inside the Infinite Wealth course. So if you already have access to it, you can go on in the course, and there's a tab for long-term care. And if you don't have access to the course and you want to get it, hop on a discovery call and we can show you how you can get it for free. Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Guys, welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our guest, or our co-host, Anthony Faso. Our guest today is Ken Hurley. Hey, Ken, thank you for being here. Welcome.
Thank you. Appreciate you having me on today.
Absolutely, Ken. We've known you for a while, and you are the go-to guy when it comes to long-term care in our industry. And it is a topic that we've been wanting to discuss and bring to the forefront with our listeners for a while. So we're excited to have you here.
Thank you.
Absolutely. Ken, if you could, Anthony, I know you really well, but if you could maybe just give us a brief introduction about your background so our listeners kind of know where you're coming from.
Sure. I have been in the long-term care industry since before it was actually called long-term care. When I first started in the long-term care industry 37 years ago, it was referred to as nursing home insurance. And it's anything but nursing home insurance today. It is truly long-term care insurance that covers so many more facets than just a nursing home. In fact, that's kind of the least thing that people ever want to use when they need long-term care. So I've been proud to see a good change in the long-term care industry. It's treated myself very well over the last 37 years. I've had a lot of fun with it. I've spoken in just about every state in the country on the topic of long-term care planning, because that's really it's all about, is having a plan. And every plan is different for every client. And I'm just happy to have been able to spend my career in the world of long-term care planning.
Ken, as long as you've been in the industry, I know that there's been some changes, drastic changes over the years. Can you share with our listeners maybe how the long-term care industry or the nursing home care has evolved over the years to where we are now?
Yeah, sure. So when I first started back in the mid 80s, and it was nursing home insurance, and that's exactly what it did. It only paid for nursing homes. It was pretty restrictive in that you had to be in a hospital for 3 overnights to qualify for a long-term care claim, or I should say a nursing home claim back then. And then the next thing that in the evolution of long-term care was the advent of assisted living facilities, which interestingly, a little sidebar on assisted living facilities, about 10% of the people that go to assisted living facilities aren't there because they need to be. They go there out of luxury, actually. People that as they get older and maybe a spouse has passed away and they don't need the big home any longer, and they move to an assisted living facility where somebody else cooks them 3 meals a day and cleans their apartment and really makes life easy on them to where they just don't have to do some of those day-to-day household chores that they once did. And so they move there out of luxury. The majority of the people there are there because they need to be. So assisted living was added to long-term care policies. And then ultimately we got to home health care, which is where the majority of the people want to stay. I don't know about you, Cameron or Anthony, but my guess is, because I know you well enough to know that if you ever needed care, you don't want to go to a nursing home or an assisted living facility. You want to be able to stay at home, which is really what everyone wants to do, is be able to stay at home. And when we look at long-term care, and specifically long-term care insurance policies, somewhere in the 75 to 80% of all of the long-term care claims that we see today as an industry are for people to be able to stay at home. That's what the consumer wants. That's what they should be able to receive if that's in fact what they want and can get the care they need. Interestingly, the care at home is given in many cases by people from other countries, that immigrants. And depending on where you are in the country, you'll see different immigrant groups that tend to be the caregivers. And that's not always the case, but I'll give you 2 examples. I live in the San Francisco Bay Area. This is where I'm born and raised. I live 20 miles from where I grew up, which I grew up in Marin, just the other side of the Golden Gate Bridge. And now I live in Sonoma County, where, little sidebar once again, I live in Sonoma County where they make fine wines. Napa's where auto parts come from. So I just want to make sure people know that one. Yeah, Napa people don't appreciate that.
Taking shots. Okay, kid. Yeah.
Just a little humor for the day.
Yeah.
But interestingly, in the greater San Francisco Bay Area, it tends to be the caregivers that are pretty well known, pretty popular, is people that are from Fiji, so Fijians. If you go to the greater Chicago area, it'll be Polish immigrants tend to be the primary caregivers there. So different parts of the country have different groups of people, ethnic groups of people that provide care. That's not to say that others don't, but it is kind of interesting that depending on where you are in the country, you might see a different group of people that tend to be the home health care providers. With my own family, when my father needed home health care, we had a lovely woman who was Fijian, who had been in the United States for many, many years providing care, and she was phenomenal at taking care of my dad's needs for the last few years of his life.
Ken, thanks for sharing that. I've met with people over the years that have had some long-term care policies in place, and they've been pretty old, actually, right? So if I've seen one, it's usually been around for a while.
Yeah.
And typically there's a lot of frustration that surrounds kind of that policy, that product. Usually they got it and they had some pretty decent benefits. And over the years, those benefits have been decreased. And then also they've got some notifications that the premiums have actually increased.
Yeah.
What has happened, right? And it's also my understanding that there used to be a pretty broad spectrum of providers that were available, but over the years that network of providers has shrunk quite a bit. Why?
Yeah.
Is that true, and why is that?
Yeah, so address a few of those questions. So when I first, once again, started in this industry, there was greater than 100 carriers, insurance carriers, that provided some type of nursing home care, and then fast forward into long-term care policies. And today there's probably around 20 carriers. So we've seen a contraction of carriers. Not everyone has stayed in the long-term care industry, but that doesn't mean that the policies go away. That just means that the carrier they bought the policy from just no longer is in business to sell new business, but they still service and manage those policies and take care of the client's needs and deliver on the promises that they've met. The other thing that we've seen with a change in long-term care, and actually, let me go to the rate increase. So the older nursing home policies, or the older, what we refer to as traditional long-term care policies, and I can explain the difference between traditional and asset-based. But traditional long-term care insurance policies, which are really have been around a little bit longer than asset-based long-term care policies, those policies have had rate increases. And in some cases, when we've seen people that have taken a reduction in benefits, it actually wasn't that the carrier reduced the benefits. They did, but it was only after the insured authorized a reduction in benefits to keep the premium down. What's happened is with these rate increases, in some cases, the clients have been given the opportunity, the new premium, I'll just make up a number, went from $1,000 to $1,500. And if you don't want to pay the additional premium for that same benefit package that you have, you can reduce your benefits and we'll keep your policy premium at $1,000. So they'll take a reduction in benefits. It might be the duration of how long the policy will pay long-term care benefits, or it could be the daily or the monthly maximum of benefits that gets reduced to bring that premium back to that original $1,000 premium. So that's what we've seen. Why is it? There's really a few reasons that we've seen rate increases. One, and this is the good news for the consumer, bad news because of the rate increase, but what we've learned is that consumers don't cancel these policies. Once a consumer buys a long-term care policy, in the first year, we get about 2% of the people cancel the policy in that first year of coverage. They just decide it's not for them for whatever reason. And then every year thereafter, what we refer to as a lapse, or cancellation of the policy, is only about 1% or a little bit under 1%. When we look at other types of insurance products out there, other types of health insurance, and really just about any other insurance you look at, lapses and cancellations are much higher. And so until we had learned this as an industry, we used some assumptions that were a little greater than the 1% in the years following of the policy. And so now it meant that more people kept the policy than expected, which meant there was more claims than expected. And that's one of the reasons for the rate increase. The other reason for the rate increase is if you go back, 2007, 2008, look where interest rates were. And what did they do for the next roughly 15 years? They did nothing but go down, down, down. And it's really only been, and I'm speaking more your world and your expertise, but it's only been in the last really 15, 18 or so months that we've seen interest rates start to come back. And insurance companies rely heavily on those interest rates for their investments to be able to offset some of the costs of future claims is from how they invest the reserve dollars. And because the interest rates were so low for so long, that affected the pricing as well, which meant carriers that had older policies that were counting on a higher rate of return on their investment and didn't receive it had to raise rates to make up for that lost income that they weren't receiving from the interest rates. All right.
Yeah, Cameron, I would tell you what. I'm sorry.
No, go ahead.
Rudely interrupted. Go ahead.
Yeah, I'm sorry. Cameron. I'm not sorry to you, Cameron. I wanted to say that what you're saying happened to my parents, where they had more of the traditional long-term care policy. Then we got a letter. Premiums were going up, just like you said, 50% more, or you could lower the benefits. And my mother-in-law got pissed. I've been paying this thing. I mean, I knew when the premiums were due is in November because they were complaining about it every November of paying these premiums. But I think it was very valuable to have it. And when they got this note increase, my mom-in-law, she wanted to cancel it, but I'm like, Mom, no, we're 78. I know we've been paying into it for a while, but like now is when we need it. I didn't tell her this, but if she would have canceled it, I would have paid for it myself.
Sure.
Like eventually things are going to come down to the next generation. And so fortunately she kept it. And my mother actually is went to assisted living, and she needed to, but her lifestyle jumped up. I mean, she lived in the same house from when we were younger, or like from when I was born. And now she had a nicer place, food, laundry. It was almost like I kind of told her she was in Cabo, an all-inclusive resort for like Sun City, Cabo, right? But I would say that long-term care policy we have for her has literally been a lifesaver. To be able to give her the care that she needs.
Yeah, they really can be. And I've heard so many stories throughout my career of how long-term care insurance policies of any type have, whether it's saved the family home, the family farm, or just the quality of life when the person needs long-term care is so much greater and so much nicer because they have the resources to be able to pay for the different services that client needs versus how am I going to pay for this home health care? How am I going to pay for this assisted living facility, this nursing home, and having to sell off, the home and other assets that, we've worked 30, 40, 50 years of our lifetime only to find out that we lose it virtually overnight for long-term care. I don't know about you, but that's not what I'm working for all these years, is to be able to spend it all on long-term care. So I want to protect myself against it.
Kim, Ken, you've been in this space for quite a while. Why is long-term care important to you?
It's important to me because I've seen what it's done for my own family with my grandmother experienced a long-term care event, and most recently both my parents, but just how it can really help people, and the stories that I've heard over my career of how people that didn't have long-term care coverage and what it did to their families. And then the flip side of that is also the great positive stories, to Anthony's point a moment ago, about those people that do have long-term care coverage and how it was a game changer in their life, that if they didn't have long-term care coverage, they're not sure what would have happened in being able to keep that person at home or into a facility, or just that quality of life. And it's really, it's been a great business to work in. I have friends in all over the country that I've worked with, advisors like yourself and other home office company employees that I've worked with. And it's just been it's a great industry. And when I talk to most people like myself that are a home office employee that are out there supporting advisors, they have their own personal story. There's not too many wholesalers like myself that don't have a personal long-term care story. And so, and that's true of a lot of advisors and insurance professionals that sell the product, that they've had a family experience and they understand, because their family member either didn't have coverage or because they did have coverage, how the impact that it made. And so they're just believers in it. I'm a huge believer in it because I know what it's done for so many tens of thousands of people that have had long-term care and long-term care experiences.
Now, can you explain in regards to long-term care? It's not just the nursing homes. It could be assisted living, or even the ability to have a care provided in your house.
Yes.
So what would you say are some of the risks of not planning for this risk?
Yeah. So, not planning for the risk can be financially devastating. It can tear families apart. For so many people that are married, for example, especially us men, we're the worst because we think my wife's going to take care of me. Well, it doesn't always work that way. Think about today. So you can tell I got a little bit of a round face. I'm a big boy. Okay. I don't know if today, if my wife, I'll be 59 next week. My wife's 57. I don't know if something happened to me tomorrow, I don't know that my wife could lift me in and out of bed, in and out of a chair, help me get dressed, help me take a shower. And that's today, and we're young and we're healthy. Think about when we're 80 years old, which is when most people need long-term care, is right around age 80. Think about my wife at age 80. How's she going to move me then if she can't do it today? She's not going to get stronger as she gets older. I'm sorry, it just doesn't work that way, right? So that's one thing to think about. Spouses will do everything they can for you, but there's limitations. The family in general can be, it's very difficult. When my two sisters, when my father needed care after my mother passed away, we jumped into action to help take care of my dad. And he didn't need a lot of care, but he needed to be watched over, made sure he took his medicines a couple times a day and meals and those types of things. And so my sisters and I were ready to jump in. I was still working full time. I travel for a living, so I'm gone a lot. So I wasn't the most reliable person, which meant it was my two sisters that also lived a lot closer and were retired, had to take care of more of the things than my father. And generally it's one of the children that jumps in and either provides the care or pays for the care. And then what happens is it tears the families apart, because that one sibling that provides all the care or pays for all the care later on says, why did I have to do it? I love my mom or I love my dad, but why was I the one that had to do everything? And as I like to tell people, it tears families apart. And by having a long-term care plan in place, and a long-term care plan doesn't always mean insurance. And we can talk about that, and I'd love to talk about that a little bit, about a plan in general. But having a long-term care plan in place means that it won't tear the families apart, and that unfortunately at that loved one's funeral, you and your siblings will still be speaking to one another because one person didn't take on the entire burden, whether it was financially or emotionally and physically. So it tears families apart if you're not planning correctly. It can wipe out, as I said, life savings. People have been forced to sell family farms, the home. It's just not what we've worked our whole life for, to have the last, in some cases, few months to few years, everything lost by not planning for a long-term care event. And so it's important to plan ahead for long-term care.
Ken, you mentioned having a plan in place and it not being solely on insurance. Can you expand on that? What does that mean?
Yeah, sure. So thanks for that, Cameron. So when I look at long-term care planning, there's a few things that we need to look at. So the first one is, some people say, I'm gonna pay for this out of my own pocket. I've put enough money aside, and that's going to be my long-term care plan. And that might be the case for some people. They do have the financial means to do so. I would argue that maybe they still want to have some coverage. And I'll come back to that in just a moment. But even if you do decide you're going to pay for this out of your own pocket, you still need to have a plan. You need to have a written plan, because let's just say I've got some money at two different financial institutions. Normally I use them, but I probably shouldn't name a financial institution. So I've got money in two different banks. I've got some stocks and I've got some bonds and I've got different investments. And at Bank A, I love the tellers, and at Bank B, the tellers aren't as nice. Well, so when I need care and I have to pay, and I'm incapacitated, so my kids step in and they're going to manage my financial affairs, and they don't know that I don't really care for the tellers at Bank B. But my wishes would be, let's drain Bank B first, because I really don't care about that bank like I do Bank A. Maybe I bought a stock and it has I have an emotional connection to it, and I want that stock to be sold versus this other stock that, hey, I just bought it because it looked like a great opportunity. So just having a written plan of how to divest our finances is important, to make sure we do it the way that I'd want my money to be spent on my long-term care. And then when we have money that we can spend on long-term care, and I'll use my own self, my wife and I, when we bought, and we actually have a few long-term care policies. Makes sense, right? Since I'm in the business. But when and if we ever need long-term care, the policies that I've put in place will not pay 100% of the cost of our long-term care. And I did that knowing that would be the case. What I wanted to do is I wanted to take enough of the risk out of my pocketbook and put it on the insurance company. I still, when I retire, as many people, when they retire, they've got X amount of dollars that they have for their core expenses. But if you've done well and you've planned well, hopefully you've got some discretionary income that's to go out to eat and to go to the theater, to go to ball games, to travel, to go to the movie, whatever it is that you like to do that is beyond your everyday living expenses. So you've got this discretionary income. Well, I know we're going to have enough discretionary income that, at least I believe we will, that we'll be able to make up the difference between what our long-term care policy will provide and what the cost of the care will be. Additionally, some of those things that my wife and I like to do today that we'll do in our retirement, if something happens to one of us, some of those things are going to stop. If we like to travel and I'm incapacitated, or I just, for whatever reason can't travel anymore, my wife's not going to go without me. Well, she may, but I hope that she wouldn't, that she'd stay home with me. So all of a sudden, those dollars that we were using to pay for travel, we could use to offset, to pay for some of the cost of long-term care. So I can bring my premium down of what I actually need to buy in the way of long-term care coverage. And that's a decision that everyone's going to look at a little differently, how much they can fund out of their own pocket versus how much they want of that risk to hand over to the insurance company to pay for it. And in fact, some people say, if I'm going to buy long-term care coverage of any type, I want it to pay either 100% of the cost, or I don't want it to pay anything at all. I'm not buying it. And that's fine too. Everyone's got a little different risk tolerance, and that's what we have to build the plan to meet that risk tolerance for every individual. And that's the beauty of the long-term care policies on the marketplace today, is there's a lot of flexibility to mix and match and make them work for you personally.
Ken, on that note, what are some of the solutions available to pacify this long-term care risk?
Yeah, so today there's really two different types of long-term care coverage. There's what we refer to, and I referred to it earlier, as traditional long-term care, and that's the world that I started in back when it was nursing home coverage and then ultimately long-term care. And what that means is a long-term care policy. It's meant to do one thing and only one thing. If you need long-term care, whether it's at home, in an assisted living facility, or in a nursing home, it pays either a daily or a monthly benefit for every day that you need that care, either at home or in a facility. There's some negatives with the traditional long-term care insurance. One of them we already talked about a little bit, Anthony, and that was the rate increases. So those policies have seen rate increases and can have rate increases, so they're not guaranteed, so they can have a rate increase. The other is they're a little more difficult to qualify for. They are an underwritten product. So we will, as an industry, we look at your medical records and your kind of your health. What medicines are you taking, and what medical conditions do you have? And then we make a determination whether or not we can actually insure you for long-term care. So that's another consideration. And then the third one is that it's and this is going to sound a little harsh, but it's a use it or lose it. And the best way to kind of give an analogy to that is think about your car insurance. You pay $1,500 a year for your car insurance year after year after year. And the good news is you never got in a car accident. And the bad news is you just spent potentially tens of thousands of dollars on car insurance and never got anything back. But what you did have, and what you did get out of that policy, is you got peace of mind, right? Mm-hmm. Not only is it required in most states to have some coverage, but most people, unless they're driving not a very desirable car, they have more than just the basic required by law coverage, because they have a nice car. They want to keep it protected in case something happens to it. But if you never use that car insurance, it's gone forever. And the same thing holds true with long-term care insurance. Now, the type of product and the company that I work for, our product works a little differently. It's what is referred to as asset-based long-term care. It's also referred to as a hybrid long-term care policy. So it's a long-term care policy that pays for long-term care, just like a traditional long-term care policy pays for. But the difference is as we like to say, it's built on a life insurance chassis. And what that means is that if you never use it for long-term care, there's a death benefit for your beneficiaries if you never use the policy. So all this premium dollars you're spending over the years, it's not gone forever if you never use it for long-term care, because not everyone will file a long-term care claim. So for those folks that never have a long-term care claim, they're protected for their entire life. And if they just one day pass away in their sleep, which is what we all hope for, right, is to just one day just go away in our sleep. It doesn't happen that way always, but if we do, now you've got a life insurance, a death benefit that is a tax-free death benefit that's left to your beneficiaries, whether it's your children, your grandchildren, the charity, whoever that may be. So you weren't just spending this money and never receiving anything. And yes, you didn't receive anything because you passed away, but your family did, or whomever you left that death benefit to. The other attraction to these asset-based or hybrid policies, they're also guaranteed. So they can't have rate increases. The death benefit, the long-term care benefit, and the premiums are guaranteed. What they show you is exactly what it's going to be. There's also more flexibility in how you can pay for these policies. So with the company that I represent, it can be, you can pay one big check and never write a check again. You can write pretty good sized check and a smaller check every year. You can pay for 5 years, you can pay for 10 years, you can pay for 20 years, or you can pay to age 95 and then it's a paid up policy. So there's a lot of different ways that clients can pay for the policies, which just makes it that much more appealing because every client, once again, is a little different of where they are financially and how they want to pay for an insurance product. So a lot of flexibility there as well.
Well, now, isn't there also an option because a lot of people have money in their IRA or 401k?
Yeah.
You want to explain how we can use that?
Sure. That's another great way is to be able to use qualified money, IRAs, 401k. So we don't avoid paying the taxes. So let's just get that up right out front is that you still are going to have to pay the taxes. What we do, with the exception of the state of California, it works a little differently, but I'll just stick with the other, of course. Yeah. Also, and I live in California, so I'm just used to that. So how it works in the rest of the country is we take a transfer from, let's say, your 401k or your IRA. And every year we're going to, for 10 years, we're going to take 1/10 of the value of those dollars out of the policy or out of that investment, and it's going to pay for the long-term care policy. You will be taxed on that distribution because we're going to take 1/10 out. That's a distribution. You'll pay tax on it. And sometimes, people say, oh, so now I have to pay tax because I'm buying this policy. And I always say, wait a second. The minute you put money into that qualified account, you knew that you were going to have to pay tax eventually on those dollars. It was a great idea to do it for the future, but at some point, the government wants their taxes. So it's just a nice way to be able to take money out of qualified money and over a 10-year period of time, just take a little every year out of it to fund your long-term care plan. And really all you're out is you're just paying the tax. So that's another great way to fund a long-term care plan.
What I see, if you were to get a long-term care policy, one of three things are going to happen. You're either going to use it or you're not going to use it, and which you've already described what happens on both.
Yeah.
But the third option is, what if you're like, hey, I don't want to do this. I want to cancel this. Yeah. How is this asset-based different than traditional long-term care?
Yeah, great question, Anthony. And the third piece to that is that if you decide in 10 years to cancel your policy, there's some cash surrender value. Are you going to receive all of the money you paid into the policy back? It could be yes, could be no. And let me explain that. If you pay for this with one check and that's it, more than likely you'll get all your money back and then some. If you pay it on an annual basis, it's going to be a smaller dollar amount because we hadn't collected as much, and the cost of us not collecting the money up front it works out different to how we're able to return some of that cash surrender value. But in any case, no matter how you're paying the premium, there will be some cash surrender value returned to you as the policyholder when and if you decide to cancel the policy. Fortunately, as I said earlier, excuse me, we just don't see a lot of people canceling their policies. They realize that the younger they are when they buy the policy, that the cheaper it's going to be to hold that policy. So we don't see, this isn't like our car insurance where we're insured with this company today and 3 years later we go to that company and we're moving companies, which some people moved often with their trying to chase rates, so to speak. We don't see that in the long-term care industry. People buy these policies and they just put them in their safety deposit box or in their wherever they keep their important financial documents, and they just kind of forget about them until they need them. And so we don't see a lot of people canceling policies, but if they do, there is that cash surrender value.
Ken, we've seen a lot of states are incorporating an additional long-term care tax, that if you don't have a long-term care policy, you're going to pay an additional tax, a payroll tax. Does this type of asset-based long-term care qualify? Yeah,
good question. So far, there's actually one state, and that was the state of Washington, that put a plan in place that you're referring to, Washington Cares Act, and they do have a tax, and the tax is it's 0.058. So for every $100 you earn, you pay 58 cents. So you earn $100,000 a year, you're paying $580, and that provides a small long-term care benefit. If you have whether it's a traditional long-term care insurance plan or an asset-based long-term care plan, that will satisfy the state that you can opt out of the paying that tax. There are an additional 12, 13 or so states looking at implementing some kind of a similar plan. A few of the states are a little farther ahead. California is one of them that is looking at doing something. Senate Bill 567. Who knows when it's going to pass, but it's just it's out there. And my biggest concern of any of the proposed state taxes that I've seen to provide a long-term care benefit, my biggest concern is it's going to give a lot of the American people in those states a false sense of security. If I look at the Washington plan, which is the only one that's truly functional today, it's a very limited benefit. It's a 1-year benefit at $100 per day. Well, just knowing the cost of long-term care, $100 a day, maybe it'll cover 30 or 40% of the cost in the state of Washington in most areas of Washington. So it's not necessarily enough coverage. And 1 year, that's nice. It's better than no coverage at all. But for so many people that are going to need care longer than that, it's going to leave them short. And for some people, they might think, well, I'm covered for long-term care because I have this benefit that was provided from the state of Washington, and I pay a payroll tax for it. Well, and then until they find out that it maybe really didn't provide as much as they thought it would, or they just don't have enough education about the cost of long-term care and how long long-term care could last for a lot of people.
Ken, one thing you're missing is that the government is such a good steward of money. So them handling this, I'm sure, will be a benefit for everyone in the long run.
Ken, I got a question for you, right? As we're talking about the cost of long-term care, you just referenced, hey, the state of Washington, it's a 1-year supplement of $100 a day. Do you have any resources available for somebody that wants to look at some practical numbers, right? Is there somewhere they can go to look up and say, hey, what is the average cost of nursing home care, in-home care in my area?
Yeah. There's actually quite a few different resources out there. One of them is if you were to just Google, cost of care, One America Cost of Care Survey, that'll come up and give you a website. There's a few other companies that have cost of care surveys, and you can actually, with most of those different websites, you can go right to the state that you live in, and even in most cases, either the metropolitan city you live in, or if you live in a smaller area, you can go to that region and see what the cost of care is, not only today, but you can also project it out 20, 30 plus years out to see, based on experience over the last 15 or so years, how the cost of long-term care has gone up. And the best we can, the only thing we can do is use prior data to project future, but it still gives you a rough idea of what the cost could be in the future. So that's another great way to just have a good understanding for what long-term care could really cost you as you get older, as you approach that age where you might actually need long-term care.
I would say when my mom has been in assisted living, I want to say 4 years now, every year, 5% increase.
Okay.
Except for this year, it was 7. But that is going to compound. And I think the problem is, even with my mom, she's healthy physically, like inside, but cognitively is where she struggles. Mm-hmm. So one of the concerns is that she may need this care for a very long time. Yep. And one of the problems with her policy, believe me, I'm so glad we have it. And we can't even get those anymore. They don't even sell them because there's even a 5% inflation rider.
Mm-hmm.
So it's a great policy. But the problem is it's going to expire. There's only so much of a benefit. And hopefully, I mean, I don't know, there's concern that we may eventually drain that. How does that relate to with an asset-based policy?
Yeah. So with One America, the company I represent and work for, we actually have something that's rather unique. We're only one of 2 companies in the industry that offers a lifetime benefit. So, people with Alzheimer's, dementia, the average claim is about 8 years. So it can be a long time. And we've had claims that have gone much longer than that. So claims can last a long time. With our lifetime unlimited coverage, the benefits never run out. Most people have some type of a limited plan, whether it was 3 years, 4 years, 6 years of coverage. And when they go on claim, it's going to run out at some point, potentially, if they need care for a long period of time. We've also seen that people with limited benefit policies hesitate to file a claim when they need it because they're afraid they're going to run out. And when you have a lifetime unlimited plan, such as the plan we offer, you never have to worry about it running out. It is unlimited for as long as you need long-term care. It will never, ever run out. And so it gives you a little more assurance that you can file a claim when you need it. You don't ever have to worry about what happens in 4 years when my coverage runs out, or in 6 years when my coverage runs out. This never runs out. We'll send you a check every month for as long as you need care.
I will tell you, I'm not sorry to interrupt because I saw you going for it, but that's exactly what we do with my mom, is that we intentionally waited. We played a little risk, you know, that we actually waited a year to make sure that we could have more money in the future.
Yeah.
Ken, I heard you say earlier that average age of people that need that is 80 years old. When I heard that, I thought that I can wait till I'm 79. When should people start to look or consider? What's the ideal time to look at getting some sort of long-term care, or these hybrid policies you're discussing here?
All right. So Cameron, my answer is you're going to roll your eyes and say, yeah, typical insurance guy, home office guy. It's today. So the younger you are, the better off you are to buy the coverage for a few reasons. One, the premiums are going to be lower because you're younger. Yes, you're going to pay for more years potentially, but when you look at the lower cost versus the extra years, it tends to still be less expensive than buying later in life. But even more importantly than that, I mentioned real briefly, I think I did, and if I didn't, I apologize, underwriting. So these long-term care policies are underwritten. And so you have to have some level of good health. Well, the younger you are, the healthier you are. We don't, just like when I was talking about, it'll be easier for my wife to take care of me today versus when she's 80. We don't get stronger when we get older, and we also don't get healthier when we get older in most cases. So that's the other reason to buy it young. Now, something that I also want to mention for younger clients, and when I say younger, I mean folks in their 40s that start looking at long-term care. And not a lot of people buy in their 40s. Most people buy when they're in their 50s or so. That's kind of the starting time when we see people buying long-term care coverage. But for clients in their 40s, one of the things that we recommend, and we're starting to see more and more people looking at this, is buying a small policy today to get some coverage. It might not be all the coverage you're going to need, but because you're younger and you're healthier, the rates are going to be less. Buy some coverage today. As you get older and your income increases, you get closer to paying that house off. Maybe the kids, you start graduating some kids off the payroll because they're graduating from college. And now all of a sudden, some of those dollars that you're using for other expenses have freed up. So you buy a second policy, you buy a third policy. And so you buy policies as you go. And the upside of doing that is it will cost less over your lifetime. If you buy a policy when you're 45 and then you buy a second policy when you're 50 and a third one at you're 55 and you were going to buy a fourth one at 60, but something happened when you were 57 years old and you had a health event that you couldn't otherwise now qualify for a policy, well, at least you've bought 3 out of the 4 you were intending. So maybe you only have 3/4 of what you really wanted, but it was better than saying, well, I'm just going to wait till I'm 60 to buy coverage, only to find out because you waited till you were 60 and you had this health event when you were 57, now you can't get anything at all. So we do see people buying some policies along the way as another way of taking care of the long-term care risk. You don't necessarily have to buy it all at once if you're younger, but look at, buying a few policies over a period of time.
Good stuff.
Great point. Ken, is there any questions or topics that we haven't asked you that you think we should bring up?
Yeah, I think the only thing that I always like to say is you just need to have a conversation. That the most important thing that for all your listeners is start having that conversation about long-term care planning, what's right for you. Everyone, and I know I've said this already, everyone's going to look at it a little differently. If I were in front of your audience and I talked to each one of them separately, and let's just say everyone in the audience said, yeah, I want to have some type of long-term care coverage. The one thing I could promise you, I won't build the same policy twice because everyone has a little different need. Even, Anthony and Cameron, even if I were to sit down with the two of you and put a plan in place, I know you already have plans in place, but if you didn't, and I was going to build something for the two of you, I'd build something totally different. And part of it's because you're a different age. There's lots of lots of reasons why, but nobody buys this. No two people buy the same thing. Everyone's going to look at it a little differently. The other thing that I haven't mentioned that I just want to throw out there, if you're a business owner, there's also some tax deductibility that you can take advantage of. If you're a C Corp, you can deduct even more than other types of businesses, LLC, S Corp, et cetera. There's still some tax deductibility. So that's another reason why some people, when they look at back to this buying more than one policy, they might buy more than one policy because at different ages, there's different amounts you can deduct. So maybe the person that's 55 buys X amount today, knowing that when they turn 61, they can deduct even more. So they buy a second policy then to take advantage of the tax deductibility. So that's another thing that we should also, be talking to the folks about is that, do you own a business? And it doesn't have to be your primary business. It could be a side hustle. You're still a business owner. So it doesn't have to be your primary source of income. If you have a side hustle, a second business, still might be some tax deductibility for you, and that's also important to take a look at.
Great, Ken. Thanks.
Welcome.
Ken, you've answered all my questions. Anthony, you got anything else?
No, Ken, you were a wealth of knowledge. We appreciate you coming in and sharing. And if someone is curious and wants to learn more, in the show notes, there'll be a discovery call. You can hop on a call with us, one of our coaches, and we can help walk you through whether it's infinite banking or long-term care, or even maybe long-term care for your parents. I think that it is a risk that can really change the retirement plan that you've set up, and that needs to be managed. You at least need to know what your options are.
Absolutely.
Absolutely, Ken. Thanks again. Really appreciate you being here, and really appreciate the 30-something years of your insight that you shared with us. Thank you again.
Thank you. Appreciate the time.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.